Let's bring in Zhihan Ma, the senior analyst over at Bernstein, covers many of these hardline retailers. Zhihan, thank you very much. Let's first of all talk about just how much home improvement is going to be impacted by some of the dynamics that we saw out of Trex this week.
Yeah, so overall, we're still pretty cautious on the trend in home improvement, at least in the near term. Not only are we seeing still a fairly muted home improvement market based on Home Depot and Lowe's, their peers reporting, their competitors reporting, everything seems to be fairly weak for now. And the two of them are also lapping the hurricane benefit from last year, which was, as you rightfully see on the screen, 55 basis points for Home Depot, 100 basis points of tailwind for those two companies last year that they're lapping this year. So far, we're not seeing a great degree of optimism in the space right now. Now, clearly, there could be more macro optimism going into next year as people expect more rate cuts to drive more demand in home improvement, but we'll have to see. For now, unfortunately, not too much good news to report.
All right, so with that in mind, if you take a look at the two biggest players out there, we're talking, of course, Home Depot and Lowe's. Which of those two is positioned for the better 6 to 12 months coming up? The performance so far has been at least more muted for some of these types of plays.
Yeah, so we prefer Lowe's over Home Depot in the medium term. And part of that is, as you mentioned up front, Lowe's is trading at an almost all-time high valuation discount to Home Depot, a lot of which I think is somewhat backward looking because Lowe's is the more cyclical between the two. And over the past 2 years or so, when the housing market, the home improvement market has been pretty muted, Lowe's saw more downside than Home Depot. But even when we do see a rebound, given the cyclicality of Lowe's, we expect them to benefit more on the upside. And meanwhile, Lowe's has more cost savings opportunities, and the valuation gap also provides more buffer from a downside protection perspective. So we like the risk reward better in Lowe's in the near to medium term.
All right, so Lowe's over Home Depot. Another key point here before we let you go, Zhihan, is this idea that the contractor business has always been a key focus for traders and investors with these prints. Just how much is that so-called pro customer going to be a factor, better or worse, for Home Depot or Lowe's?
For now, the important dynamic also to keep in mind is that both are entering into the complex pro market. So basically, the bigger ticket pros who are making planned purchases, we're going to see both companies updating their guidance this upcoming quarter to reflect the acquisitions they've recently made. Those are most likely going to be margin dilutive in the near term. But that aside, in terms of the broader pro market, we're expecting some near-term weakness or mutedness at the very least, based on their peer and suppliers reporting. The housing market, the new construction market, the roofing market, unfortunately, are not showing any signs of recovery right now. All hopes on next year.